Okay, people, the second video we're covering 1031 exchange. As I have been saying all along, I have by public record sold houses in as little as 1 hour and as much as 90K over asking. At the current market, I have sold 3 weeks. The current sought after average in the local market is 2 weeks. If your agent is not performing at this rate, you're at a definite disadvantage. I've had people actually say I'm not in any big hurry, but that means you'll have to eat holding costs of the thousands for the mortgage and many other expenses. You should definitely not wait till the last minute to find a qualified agent. I've known and interacted with scores of expert agents, including myself. I was talking to a woman the other day who said her and her husband were investors, house flipping, renting, which is what we're covering here today. The short answer is that she hired an agent introduced by her son because they shared a common occupation, day job. This agent, while telling her listed the property and cut the asking rate the day after listing by $20,000 without informing her. That is a major no-no in this business, regulated by ethics, by a commission with the authority to impose fines, etc. for non-compliance. Refer to my previous videos, 10 questions asked before hiring an agent, 8 costly mistakes sellers make buying and selling a house at the same time. Waiting until the last minute, even if well-intentioned, taking a referral without checking their public record, not just how many houses they have sold or bought, cost them minimum $20,000, probably more. I have a private public Facebook group where many intelligent people have joined for educational purposes, as well as the convenience to reach out when the time comes to experts, not just somebody your son plays pool with on Friday nights. Think you're up to it, you can do this totally on your own, but I recommend you hire an expert, especially in today's market. So this is provided for educational purposes. Okay, we have already covered much in 1031 exchange, but before we go any further, you'll need to know how to cover cap rate. If you're contemplating your inaugural investment, one term that you probably keep coming across is capitalization rate, or cap rate. This term may seem somewhat esoteric, but it's arguably the most ubiquitous criterion for evaluating an income-producing real estate investment. It's also an exceptionally simple formula to calculate. What is a cap rate? A cap rate expressed in anticipated annual return on investment. How is a cap rate calculated? In order to calculate a cap rate, the investor needs to be in possession of 2 data points: the asset's market value or asking price and the property's net operating income, NOI. A property's NOI is established by starting with its annual revenue and subtracting annual expenses related to operating and managing the asset before the debt service. To determine the cap rate, an investor will divide the property's NOI by the listing price of the asset. Why do investors use cap rates? Cap rates become dominant in real estate over the past several decades as the sector was increasingly institutionalized. As real estate has become more of an institutional investment, we've seen the cap rate become the first question that anyone has when looking at a property. That's because a cap rate is simple to calculate and enables investors to easily compare properties across asset classes and geographies. More importantly, a cap rate will help an investor understand the perceived or potential risk of owning a property. A property with a higher cap rate will potentially produce a higher return, but it could also be more risky. On the other hand, a property with a lower cap rate might produce less income but offer greater stability. Of course, I advise that the notion of risk in this instance is entirely theoretical. A cap rate is really a measurement of the perceived risk of owning a property, whereas the actual risk is experienced while owning the property. How reliable is a cap rate? Well, a cap rate could be a useful initial metric for a real estate investor. It's certainly not the only calculation worth considering. That's because there are numerous facets of owning a property that a cap rate doesn't capture, including debt service and capital expenses. Investors need to be wary of the cap rate that's advertised by the seller of property or by their agents. That's because it's generally difficult to determine what expenses are accounted for in the NOI that was used to calculate the cap rate that's being presented. You can always estimate some cap rate. Whether you believe it or not is another question. For instance, many advertised cap rates will use low or no management fees, assuming the property will be self-managed. Even if that's an unlikely reality, they may also be using outdated tax figures. I also note that many listing brokers don't properly account for credit loss or vacancy loss in their NOI calculations. Credit vacancy loss refers to the period of time the property is vacant after one tenant leaves and a replacement has yet to materialize, as well as the costs associated with securing that new tenant. Credit loss is a bit of an art because it varies widely from asset to asset. For instance, a rent-stabilized multifamily property may have relatively little turnover and incur a credit loss averaging only 2% per year, whereas a retail or restaurant location may have more frequent vacancies, resulting in a credit loss closer to 10% per year on the average. Even properties that are advertised as being leased on a triple net NNN basis, which suggests that all of the property expenses are handled by the tenant, not the owner, can be somewhat misleading, as there are almost always some expenses that are carried by the property owner. It's quite rare for something to be an absolute NNN. As for the expenses that should be included in the property's NOI, the addition to vacancy loss and management fees, real estate taxes, current projected water and sewer expenses, common area maintenance, cleaning and electrical expenses, administrative and reporting costs, and insurance premiums are all elements that should probably be included. However, the approach to calculating NOI and therefore estimating a property's cap rate will vary widely based on the type of asset structure of any leases currently in place, local market predictions, and the specific investor's approach to owning and operating a property. An investor really needs to do their due diligence in order to make sure that the income is what is advertised as well as expenses. A cap rate that is derived from either faulty income or faulty expenses or both is not going to be an accurate measure that you can count on. Again, this is where I come in. I can, as an expert in this area and many others, determine not only if the cap rate was legitimately calculated, but if it even applies to the area in question. Furthermore, many seasoned investors, whether you are buying or selling, will simply just hang up on you if they feel you're a novice. Back to 1031 exchange. Again, I have done all the heavy lifting in this following, so you do not have to. What's a qualified intermediary? Qualified intermediary is a person or company that sells your property on your behalf, buys a replacement asset, and then transfers the deed to you. Let's dig into a qualified intermediary's job responsibilities a little further. They will, number one, coordinate with you, the seller, on the structure of the 1031 exchange. Prepare the relinquished asset documentation and the replacement property documentation. Give instructions and the appropriate documents to the escrow or title company about the exchange. Create an arm's length transaction in the agreement between the seller or exchanger and a qualified intermediary. Transfer to the qualified intermediary who works to convey the asset to the buyer. Handle money for the relinquished property sale and deposits these funds into a separate and insured account. Hold the funds from the sale of the relinquished property during a 45-day identification period. Hold written information about potential replacement properties. Transfer funds once the replacement property has been selected and disperses them to the title or escrow company for the purchase of the replacement property. Convey the title to the seller or exchanger by deed. Keep complete records for the seller. Give a 1099 form to the seller or exchanger and the IRS if needed for interest. Choosing the right qualified intermediary. It's important to choose the right qualified intermediary for you. Confirm that the qualified intermediary you're considering offers 1. Real estate experience. Does the qualified intermediary have extensive real estate experience? Successful completion of compliance examinations. Processors should meet annual compliance examinations such as SSAE 16. Transparency in transactions Can you view your exchange money at all times? You want to know what's happening with your money. Fund security. Make sure your funds are held in an FDIC insured account for safety. When to use a 1031 exchange. There are multiple reasons why you might want to use a 1031 exchange. You may want to, number one, invest in a property with better return prospects than your current investment property. Consolidate several properties into one, possibly for life estate planning purposes. Reset the property's depreciation. Turn your vacation home into a rental property and do a 1031 exchange. For example, you'd stop using your beach house, rent it out for a few months, and then exchange it for another property. Sell your investment property and invest in more than one property. For example, you could buy 3 investing properties if you want to. There's no limit. However, if you buy more than 3, your qualified intermediary will have to go over some extra rules with you for financing multiple rental properties. 1031 exchange rules and requirements. Let's discuss the rules and regulations that pertain to a 1031 exchange, including property requirements and time requirements. Property requirements. The property exchange must abide by certain requirements. 1. The replacement property must be like kind or of equal or greater value to relinquished property. Both properties must be similar enough to qualify as like kind. Most real estate can be like kind to other real estate. For example, real property improved with a residential rental house is considered like kind to empty land. Note that property within the United States is not like kind to property outside the United States. The exchange properties must be similar in nature and function. For example, a rental or multifamily property cannot be exchanged to acquire a vacation home. Personal use as residences, such as a primary residence, second home, or vacation home, do not qualify as like-kind exchanges. Actual property and personal property, which can include machinery, equipment, collectibles, vehicles, boats, aircraft, artwork, patents, and other intellectual property, can both qualify exchange properties under Section 1031, but actual property can never be like-kind to personal property. The rules are more restrictive for personal property as well. For example, cars are not like-kind to trucks. You cannot hold the money made from a sale during the exchange at any time. The funds must be held in escrow by a qualified intermediary, or the proceeds will become taxable. Finally, Section 1031 does not apply to these types of exchanges: stocks, bonds, or notes, other securities or debt, partnership interests, trust certificates. I hope you found this information useful. This is why I entered into real estate in the first place, so I can use my superpowers to help people achieve their dreams. Countless people have, through real estate investment, made their fortune, and that is regardless of the current market, which is nothing more than a previous market already dealt with by experienced agents. See you next time.